Hello. Thank you everybody for coming today. And for those watching online, thank you for watching this. Today, Kevin Bell and myself, partners here at Kernet Stokes, we're going to go through to some common tax questions. We do a monthly webinar every month that we throw out here and just kind of go over different topics. Today's topic is just common tax questions. What are questions that we've been getting throughout the year from our friends, from our family, from people that have been emailing in. What are just kind of some everyday questions that you guys have? And so we've got a list of those that we've received already in advance. So we're going to go through those a little bit. As always, this is not official advice. Don't sue us for things that we're saying. We're doing this to be nice. Don't sue us. We'll have to stop doing them. So, but anyways, so yeah, hopefully you guys know a little bit about our firm. We have offices in Eugene, Corvallis, and Bend, and about 100 employees. A pretty good sized firm, but small enough to still have the personal touch. So, Kevin, you have any thoughts before we get going? Did I miss anything?
Well, the only thought I guess I would have is in terms of new things is the Green Book that just came out from Biden and Treasury. They're making some proposals there. I think that's interesting. We're not going to go into much depth into it, but there are some interesting proposals about taxing unrealized gains on billionaires. So that's coming down the pike. I'm sure we'll talk about it in another episode, but I think that's interesting. And then trying to get things done for taxes. You only got a little over 2 weeks left. So if you have not started your taxes, or if you have not reached out to your CPA, tax preparer, you need to do that immediately. So I guess that's
great point. That's a great point there, Kevin. It's probably going to be difficult to ram anything through the system in the last few weeks here if your stuff's in already. So filing an extension is not a bad thing.
Yeah, I have some clients I'm still trying to get a hold of, and good for them. They'll go on extensions. That's what I'm going to tell them. So.
All right. Well, I think you made some great points there, Kevin. I'm looking forward to digging into Biden's new plan. I think anything with an unrealized gain loss is probably dead on arrival, but still interested to read through it and see kind of the proposals. It's kind of the fun part of the job for us is doing the analysis and the consulting. So
I'll throw in there, from the little I've heard and read, is that it's not a lot of different from what was proposed last year. If you remember, last year was the first time in 4 or 5 years in which a Green Book was actually published by the Treasury. And for those who don't know, a Green Book is basically their thoughts on what the tax proposals are and how it would impact in terms of the amount of taxes people would owe. And so last year was the first year. Again, like I was saying, is that there's not a lot of difference that I've heard, and it died very quickly last year. So I don't have a lot of hope, I will say, on this, that there would be any changes. So, yep. Sorry for cutting you off there.
Oh, no, yeah, to be determined. We will see. I'm going to jump into just some of these questions here. I know we're not going to spend too long today, so we just want to kind of bang through as much as we can and get people the answers they're looking for.
Yeah.
Kevin, I think the most common question we got this year is, I sold my house. What does that mean? Do I have to do anything? Is there something special I have to do with my return now that I've sold my house?
Well, of course, yes. The answer is yes. Whether or not it's taxable, it really depends whether or not the gain's taxable. You, of course, want to tell your tax preparer about it. But the rules is that if you are married filing joint and you sell a house that you've lived in 2 out of the last 5 years, and let's assume that you didn't rent it out at all during that period, then you can exclude up to $500,000 of the gain. Generally, what we see is that covers a lot of the gain. So generally, it's not going to be taxable if you meet those requirements. If you're single and you're selling a house and you meet the requirements, it's $250,000. But I have had a few clients that have pushed that upper limit of the $500,000. So those, you still got to report it. You still got to let everybody know about it. But it potentially could be taxable. Most likely, it's not.
I think for most people, obviously we've had a pretty hot real estate market lately, right? Everything's been selling. You put your house on the market, you got 30 offers the next day. So we have seen some significant gains, but I think by and large, 500,000 is a pretty big marker for most married families, probably not going to be a taxable event
Yeah.
if they've been there for longer than a couple of years. Another thing I throw out in that calculation is real estate fees. When you add in, take 6% off the top, that's also cuts out the potential for some gains there as well. So um, certainly something to happen. Question we get all the time. I think everyone gets a little nervous, understandably so. You don't want to make sure you're not reporting something correctly, but generally it doesn't create much of a taxable event unless you've got some really big numbers.
Yeah, I might throw out there also is, some of the concerns I've heard of in the past about selling their house and recognizing gain is that under previous law, old law, if you were to take that gain and roll it into a new house, you could exclude the gain or defer the gain. And there are some individuals out there, more of the older generations, that do remember that. And just as that rule is gone. It is not applicable anymore. You can't roll it over. It's a straight up exclusion. There's no other special benefits you have to do or requirements that you have to meet. I think that's important as well.
Kind of a hybrid of the like kind exchange rules that no longer applies to personal use of your house party.
Like as I mentioned in my initial thoughts, was the thing to think about is if you did rent your home for some period, since you've owned it, there is a potential that a small part of the gain will not be eligible for exclusion. I'm not going to go into the whole calculations, whatever. It's just if you have rented your home out and then moved into it, maybe your personal residence, the potential is that some of that gain will not be excludable from income, but it's usually a smaller portion as compared to the bigger picture. Brett, one of the questions that I get, you mind if I jump in here?
Yeah, no, it's just firing back and forth.
Questions I get is, I inherited, we'll call it, I inherited X number of assets, or I was gifted a bunch of assets. Is it taxable? Is this taxable? Or if I gifted an asset and I'm the giver, is this a taxable event?
Well, you asked about 3 questions there, but I'll see if I can unpack it.
Taxes.
Gift taxation is pretty confusing, I think, to most people just from a high level. It's either I got something, I must have received something, I got a tax issue, or I think a lot of times you actually see it on the other side where the person giving the gift is worried that they're creating a tax liability for the person receiving the property. And on a gift, it's you're just receiving stuff unless it was basically for compensation, which in that point just compensation. When you receive a gift, it's just a gift. The consequences to you are that you're going to likely take the basis from that person that gave you the gift, depending on kind of a few other rules, but we'll just kind of leave it at that you're kind of inherit their basis, kind of step into their shoes. And really that's about it from the person receiving the property. For the person making the gift, they could be, that's where they have the potential to maybe have to file a gift tax return that year. There's an exclusion each year of $15,000 per gift per beneficiary. So if you have 2 people you need to give $30,000 to, you can make that happen. If they live together and you want to get $30,000, you could give one person 15, one person 15. But then after that, if you go past it, you go into your lifetime exemption. And there's another really large exclusion before you actually come into what becomes a taxable gift where someone has to pay taxes on those gifts. So, likely if you've made a gift, probably not going to create any taxable issues. It might require gift tax filing based on the amount. And if you gave a ton, then yeah, there could be some chance you could pay some taxes, but it's a very large amount. I believe it's 11.7 right now, 11.7 million is the lifetime exemption, roughly. So, you'd have to give a lot before you really dipped into that. Not that people listening might not have that kind of wealth, but it isn't becoming concerning until you get kind of that magnitude.
And as a little bit of an update with what you said in terms of the annual gift tax exclusion has gone up to 16,000 for 2022. I've also had another question related to gift tax. It's not quite as common, but I'll just toss it out there real quick. If you are receiving gifts from for example, a long lost uncle who is a German resident or citizen and never has been a U.S. citizen, there could be some potential disclosures that you would need to make as the recipient of a gift, depending on the size of the gift. So if you're receiving a gift from a non-resident of the United States, on the flip side, you might be having some disclosures you need to make, but I hear it sometimes, not very often, but just toss it out there.
Oh, yeah, I mean, and one thing you can run into on gifts, is with that kind of stepping into the shoes of the person that you received the property from. Like if someone gives you old stock, stock that might have a really low basis. We've got a lot of Nike investors around here. So say you had some original Nike stock back in the day, and you gift that over. Well, you've also kind of gifted over kind of this contingent liability to an extent, because when they do sell that stock, if they were going to sell it right away, they're going to be the ones picking up the gain on that. And so it might have a large gain because of a lower basis. So something to be aware of. I mean, a lot of times people try to give money to people to use for certain situations, like a down payment of a house, or something like that. So if it's something where someone's have to liquidate it right away, there might be a potential tax gain coming on that liquidation or sale event. And then lastly, I didn't answer the inheritance side of things. If you receive a gift via inheritance, um, likely not a taxable event, might create taxable income from the estate, which I'm not going to get into because that's a pretty convoluted question. But in general, you should just kind of step into the shoes of the person you received it as of the date of the death. So you get a step up in basis at date of death. That's your new basis of property, and you kind of move on going forward.
Yeah, I do want to throw out two planning ideas in terms of gifts to get around the annual exclusion and doesn't count against it. Is that if you are paying medical bills for someone and you're paying them directly to the hospital or to the doctor on behalf of an individual, those do not count against you as gifts for the year. The other category is if you're paying for education, like college, university, and you pay tuition directly for them, that would also not count against you for gifts. Just a little planning idea, thoughts out there I toss out. So.
No, it's a great way to transfer some money out for probably the expenses that people are probably trying to pay. Obviously medical bills are a pretty big one, and yes, and college tuition, very common.
Yeah.
To see that happen where grandma and grandpa want to pay for some college, and it's an option to do it.
Yeah.
All right. Well, I think you probably beat that one up enough.
Yeah.
I think we're going to jump into the. I think one of the questions I get the most around is just kind of the area of medical expenses. What is, and kind of the question about what can be deductible. There's a couple of different things that come up. But the first question is, can I really deduct any medical expenses? And then there one's, well, what about like the insurance premiums I pay? I'm an employee, I work, I pay my employee, every month out of my paycheck comes this, $600. Can I deduct that? How does that all work? Pretty common question. What do you think, Evan?
Well, the insurance premiums that you're paying, assuming they're not going through a 125 plan, for example, you're not paying them through your employer via a pre-tax deduction, then you can deduct them if you itemize your deductions instead of taking the standard deduction. I think that's something important to remember in terms of the 529 plan, is because I have seen individuals where they're like, oh, well, it came out of my wages, and so I should be able to deduct them. Well, a 529 plan allows you to take those out pre-tax, and the IRS isn't going to let you double dip on those. So that's something to consider there. The other thing is, generally the medical expenses have to be necessary. They cannot include elective surgeries. They need to be unnecessary medical expenses and medication and such. That in addition, something that I've seen missed quite a bit is also the medical miles that you can do. If you're driving to the doctor's office, or you have to drive to a distance up to Portland. We're in Eugene. If you have to drive to Portland to see a specialist, deducting those miles along with any overnight stay, you can deduct those as well. Trying to think of anything else. In terms of medical expenses, what do you think, Brett?
I think you brought up a great point about having to itemize first before it really matters. There's kind of a gauntlet of deductibility to get through to start with. One is it has to be an after-tax cost, right? So you can't have the pre-tax stuff like the insurance premiums or stuff that's paid out of an HSA. None of that stuff counts. It has to be, post-tax, has to be more than 7.5% of your adjusted gross income, which is a huge haircut. $100,000 person, you got to get over $7,500 of expenses before you can deduct the next dollar, not just like all of it. It's like $78,000, I can deduct 500, and then I have to itemize, which means, if I'm married, I've got to have another, you know, got to get up to about $25,000 between that, my mortgage interest, and $10,000 property taxes. So definitely a hurdle to clear. And I think for the most part, medical expenses have become pretty irrelevant unless you have a lot of them. Only other thought I thought about it was just, if you are self-employed, you don't have to put them on Schedule A. At that point, you can take them on as kind of a page 2 deduction or start Schedule 2 deduction. So if you are self-employed, certainly keep track of your health insurance premiums. But to the extent that you're kind of a more rank and file W-2 employee, you're probably not dealing with it a whole lot.
Yeah, I'll add two things into that. One, with health insurance premiums and where they're at, Brent, somewhat it can be on the higher side of things. So HSAs have become very popular. Okay? And for those who don't know, HSAs, you can contribute cash into that pre-tax, and then you can take it out to pay for qualifying expenses, and those don't count as income. Those type of expenses that you're paying with HSA funds, those aren't deductible. Those are considered pre-tax deductions, so you're not going to be able to deduct it again with that. The other thing in terms of the itemized deductions, I know we're here in the state of Oregon, and the standard deduction on the Oregon tax return is fairly small. It's maybe $3,000 to $6,000. It just depends if you're married, filing joint, or single. Whereas compared to the federal is quite high. So there are going to be situations in which you kind of fall between those two standard deductions. And so even though you might be taking the standard deduction for federal purposes here in the state of Oregon, you could still qualify to take the itemized deduction. So it's still beneficial to look at what those medical expenses are, and what your other itemized deductions are, because you can potentially receive a benefit on the Oregon side. And I've seen that a number of times.
Also an Oregon medical subtraction.
There's also the Oregon medical subtraction for those of the certain ages that get that. One of the things that I know that I do with my clients and talk to is if they're itemizing, they'll send us their stuff, and we've kind of come to the mutual understanding is like, don't send me your medical stuff when I'm preparing your tax return. As we get closer to the end of the tax return, I'll reach out to them and say, okay, hey, here's where we are in terms of that hurdle, Brett, you talked about, that 7.5%. I said, okay, say the 7.5% says you have to have more than $2,000 of medical expenses. I'll reach out to them and say, okay, hey, do you guys have more than $2,000? And they'll go scrape a bunch together and say, oh, we got 5,000, or no, we don't have enough. That's kind of on both sides to save time and effort, to see even if the hurdle is worth trying to figure out to get over. So it's one of the things I might throw out there as a suggestion. Yeah. Yep. I got one, Brad. If we're done with that.
We're ready to go.
This is the next one I love hearing, and you'll hear it on Twitter. You'll hear it. Brent, I set up an LLC. I can deduct everything, right? What can I deduct now that I got an LLC? I got an LLC. I just want to deduct everything. Can I do that?
Yeah, no, certainly a lot of questions around having an LLC. I think kind of just dovetailing this into the questions that we get about, I just started a new business. I just formed an LLC. What do I need to do? And, I think a lot of people think having an LLC automatically creates kind of like the separate entity, that for tax purposes. Like now I have kind of like, I think they think it's kind of similar to a corporation, where now I've got kind of the separate entity that kind of can do its own thing. It's like, well, an LLC is likely still disregarded for tax purposes. So it's, if you start a new business as an LLC and it's just you, well, it's probably just going to end up on your regular personal tax returns to Schedule C. And at that point, yes, you can certainly deduct some expenses that are ordinary and necessary, as most businesses can. But it's not anything like, that different than just me having a business in my own name without an LLC. Tax reporting is basically identical. Now, if I have a partner, then all of a sudden we have a partnership, and that LLC is a regarded entity. We're going to file our separate returns, and then we're going to have to start dealing with allocations and different things there. So having an LLC isn't even different really, as a sole prop. It just, it's a little bit more liability protection. But tax wise, it's the same thing. It's just having a Brent Laird business versus Brent Laird LLC. It's just me. It's going to be filed the same way. It's just going to be on my 1040. So
Yeah, I might throw in there, the only additional benefit, I guess you could say, is you can pay your state registration fee of $100 or $200 a year if you want to keep your LLC. That'll provide a deduction. But in all seriousness, from a liability standpoint, an LLC will provide some liability, but that's beyond the scope of our purview. You want to talk to an attorney definitely about the liability side of things. But I agree. Yeah, LLC. You mentioned the word disregarded. I just want to circle back around with that. In the eyes of the IRS, if you are the only member of an LLC, kind of reiterating it, is like the IRS doesn't care. You just report it as a single sole proprietorship. So,
yeah, no, certainly some confusion. We get a lot of people starting up new businesses, and they always have a lot of questions, and we're always happy to kind of help people point them in the right direction to get things going. But from a tax perspective, there's not a ton going on just because you created an LLC. Now, if you created a partnership, that creates a lot more effect with partnership agreements and stuff like that. So, yeah, no, I think that's. Any other thoughts on that, Kevin, or should we move on to the next question here?
we can move on to the next one.
I think probably top 5 question I get in the office is I bought crypto. Do I need to report anything on my taxes? And it's actually a question in the tax return now. So
yeah.
I guess, Kevin, how do you advise your clients when they tell you that they bought crypto?
I would say, tell me more. But yes, in general, you're going to have to disclose crypto transactions on a tax return. Now, whether or not the transaction is taxable or not, there's some different things there. You want to look at each individual transaction. But if a client comes to me and says, "Hey, I'm doing crypto," I pull them aside and say, "Let's talk. We gotta figure this out, and we're gonna have to report it. And it's depending on how the transaction works, we could have a taxable event." But yeah, that's what I tell them, and then I kind of sink in my chairs. Hopefully, they didn't day trade crypto for for the year, because that means there could be a lot of transactions. So
yeah, I think a fair amount of people have likely, just bought crypto. And so, if you're in a main exchange like a Coinbase and all you've done is bought some Bitcoin, there's technically, I don't think you have to check that box, even that you're doing crypto transactions if it's just you're buying. But if you're selling, yeah, you're gonna have some reporting requirements. But I think by and large, I bet 50% of people have just bought and not sold.
Yeah. And the question did change this year as compared to last year. When I say last year, 2020, if you did buy, I think it would pull you into that question. So it's interesting. Now, if you just buy and hold, then you're fine. Now, we did a podcast earlier, I don't know how many months ago about this. So I don't want to go into the depths of all the different types of transactions, but yes, if you have crypto, talk to somebody. That's the big question. That's the big suggestion, recommendation. So
may need to check a box.
Yeah.
I want to throw out another one for you here, Kevin. We get this question a lot as people try to lower their tax at the end of the year. Should I buy a car for my business?
Do I buy a car? That's the one I love. Of course, the standard CPA response is, well, it depends. Okay, and it depends on what type of car you're going to buy, how you're going to use the car. Are you going to use it personally? Are you going to use it for business? There's a whole list of questions. Well, let's just kind of narrow it down to the big ones in terms of personal use versus business use. Okay, if you're going to use it, well, I'm going to take a step back. Okay, I am, just as a tax consultant, my personal philosophy is let's not let the tail wag the dog. So I'm not on board with just spending money to spend money to lower tax bill. If a client has a need for a vehicle, whether in the near future, yes, I'm all on board, whether that be buying that at the end of the year or next year, whatever. But just to buy something, I'm not on board with that. And I tell them that. It doesn't make economic sense to me. So let's just get over that hurdle. Then we go to the questions, okay, are you going to use this for all business or for personal or for both? And if it's for your business, you said, well, okay, that's great. If it's 100% business, no problem. There's some different hurdles we have to get over in terms of how much we can depreciate. If we'll call it, there's big cars and small cars. That's the way I'll put it. We'll use the 6,000 pounds. If it's 6,000 pounds or more, then generally what you can do is expense most of that right away. If it's under 6,000 pounds, then there's going to be some limit on your depreciation deductions. They call them luxury autos, okay? And the IRS said, we don't like businesses going out and buying these luxury autos and expensing them right away and using depreciation right away to get rid of, to expense them. So there's some hurdles there, depending on the size of the vehicle you're getting. Also, you have to look at the amount of personal use versus business use. If it's going to be 100% used for business, that's fine. That's great. Not an issue. But if you're going to start using it for personal use, you're going to fall into a whole other bucket of issues and concerns, which means then potentially some of your deductions related to that, related to the auto, the vehicle, could be limited because it's being used for business, for personal use. In addition, there also could be another effect that the person who drives the vehicle for personal use, depending on the situation, could have additional income as a fringe benefit. There's different ways to value that. So it's coming back to the bigger picture. What do I tell them? It depends on what you're going to do with it and how, and what the plan is with it and how big the vehicle is. But it's not an easy. There's not an easy answer for it. I guess I'll put it that way.
Can't be right, Kevin. My coworker just said I could write it all off right away if we bought it. So,
if it's 6,000 pounds, it's all business.
Well, I mean, you hear different things, and to some extent, you can certainly get some deductions, up front, depending if the facts make sense. And I think you brought a great point about the economics of things. It's like, yeah, tax planning is great, but the economics, the decisions are usually much more important than the tax impacts. We're here to optimize tax, but don't go make a bunch of bad business decisions just to go save taxes. Just like don't be worried about paying taxes if you're making a bunch of money. That's just part of the deal. We'll optimize that the best we can as CPAs, but yeah, make sure the business functions right. Also, might be difficult to buy a car in the current market environment with a lot of cars on back orders and trucks, especially different shortages going on. So, but no, great, interesting stuff there. Kevin, I'm kind of running light on my list of questions. I'm guessing you maybe have one or two left on there.
I do. Let me see which one I want to ask. Okay. I come in to see you, Brent. It's April 1st. It's April 1st and we're doing 2021 taxes. What can we do to tax plan for 2021, Brent?
Gotcha. So we're after the fact, and so we're kind of stacked against the deck in a little bit. Generally year-end planning is kind of that moment in time in November and December when we're really thinking through, what can the business expend money on, or what individually can you purchase goods and use the accelerator? Are there ways to defer income? Is there different things that we could be doing? Really, that's a lot easier task to accomplish it before the calendar year or the fiscal year closes. Once we get to this point, past 12/31, we're really limited in a few different options we have. The biggest category really that you can play around with is retirement plan contributions. Whether you're an individual and you're looking at IRAs, maybe you're self-employed, you could be looking at SEP, Simples, maybe some employer contributions for 401ks you could still be looking at. So those are really the only kind of things you can be actively still kind of pursuing as a deduction as a retirement plan piece. But the rest of the stuff is kind of already set in motion. And at this point, we're really talking about 2022 and what we can do there. So, if you got to be a little bit more proactive at that point if we're talking April 1st. But there's still some wiggle maybe with retirement plan contributions. Maybe you need to get your adjusted gross income under squiggle lower to qualify for some different deductions, or limits get better. So maybe there's still some wiggle with retirement plan contributions, but by and large, the bulk of the opportunities have probably gone away.
Yeah, and I'll just throw that out there is the best time to start planning for the tax year is now, not after the fact, like you said. And having a good financial tax consultant that you can call up at any time, and that they'll be there and talk to you and help you walk through things. That's when the planning takes place, before the transaction occurs. It's always better to talk to them before the transaction occurs versus after, and trying to either fix it or change it to make it more beneficial for you. So that would be my only recommendation on that part, is reach out to your tax consultant sooner than later if you want to plan for the upcoming year.
Yeah, and I think that's part of working with any, accountant, CPA, whatever, is that, part of, you're paying your accountant to do your compliance work, but you're also paying them so that you can have access to them, so that you can ask those questions in advance, or throughout the year. That's really where the benefit comes from, is being able to plan, add value along the way. If all you're doing is order taking tax returns, you're not using your full extent of that relationship for your CPA.
So I got one more question for you, and I'll shut up for the rest of the time in terms of questions. So what do you tell your clients when they tell you, hey, either I've never paid estimates before, or I've missed my estimate payment? What's going to happen? I hear there's penalties.
Sure. So I think as people become self-employed, it's kind of a new step in the transformation of their tax picture a little bit. That as an employee, everyone kind of pays your taxes and does your work for you. You've got withholdings, and withholdings are what get withheld back by your employers. At the end of the day, you file your tax returns, and I think by and large, 80% of Americans file and get refunds, and so they like that, right? That's TurboTax is selling that. I think at one point H&R Block was advancing tax refunds ahead of time, so that's kind of the exciting part. But I think when you're self-employed, it's a little bit of a rainy parade, because all of a sudden, there's no one did that for you, and so you have to start paying it on behalf, paying it quarterly, April, June, September, January, and then you start it again every year, and you don't really get a refund. You just get your tax payments applied to the next year, and so it's kind of a bummer. If you forget to make those payments, you start dealing with underpayment penalties, or underpayment interest. Late payment interest is really what we're focused on. And really, that's just kind of the federal rate. I think we're about 3% right now, Kevin, is the rate on it. So, it's not entirely punitive, just because interest rates across the board are very low. If we saw some higher interest rates, in the marketplace, we weren't at such low savings rates, we would see much higher rates all of a sudden for underpayment. So, if you miss a payment or two right now, be prepared to write the check in April, and you won't enjoy paying the penalties. But if we were at an 8% environment, you'd be really writing those checks on time, I think, in a lot of ways. I think there's some wiggle right now. No one loves paying an extra 3%, but no one really likes to pay an extra like 8 to 9%, and they can really stack quickly if you're not being prepared. And I think part of the exercise is just kind of, it's a little bit like saving money and putting money away. It's that same process, so that you're not just overwhelmed at the end of the day, because not only is April 15th, the due for the 2021 year, it's also the first quarter of the 2022 year as well. So you get hit with a double payment. So
I just kind of reiterating what you just said. Way I tell my clients, they call it an underpayment penalty, estimate underpayment penalty. It's really just an interest rate. That's all it is, just to remember. And I actually have clients. So the one question is, am I required to pay them? No, you don't have to pay them, but you'll just pay the interest rate later on. And I have some clients who will religiously pay those on time. They will not miss them. But I have a few clients who just say, you know what? They just look at it as a loan from the government, and they'll pay the penalty, the interest come April. They don't care. So it really just depends. But the IRS is not going to come after you if you miss a couple estimated tax payments. You'll just have to pay some interest later on. So that's just what it is.
It could be a lot to swallow at the end of the day, but there's some people that are very analytical, and they're like, yeah, I can make more than 3% over this period of time, so I'm going to do that, and I'll pay it later. So, that's okay, as long as you understand kind of what you're playing with. So,
and that interest is not deductible either.
Correct.
It's not deductible. It's not a tax deduction, so don't think you're going to get a benefit on the flip side. The IRS knows that game. So, yeah. Well,
Well, all right.
my
Well, I
last
think,
question.
huh?
That was my last question. I
Okay, I
told
thought
you.
you said you had one more. I was like, oh, you're kind of
Oh, no,
underselling
that
it.
was it. That was it. That was it.
Well, thank you guys for tuning in. If you guys have any questions, feel free to reach out to Kevin and myself. KernetStokes.com is our webpage, and we're both listed under there, so you can see our contact information and reach out. Thanks for taking time. We will see you guys next month.